Welcome to the Deep Dive, your shortcut to being truly well-informed. Today we're diving into a topic that's shifted from important to, well, absolutely imperative for anyone in banking leadership.
That's right.
We're talking about the transformative impact of artificial intelligence, specifically on the regional banking sector.
Yeah, and our main guide for this discussion is a pretty insightful strategic report. It's titled Navigating the AI Revolution, a strategic report for regional banking.
Just published last month, August 2025, by Rick Spare.
Exactly. And it does a really comprehensive job looking at these three distinct waves of AI, narrow, generative, and agentic AI.
And crucially, it unpacks what they mean specifically for regional banks.
Right.
The opportunities, the challenges, the whole competitive dynamic.
Right, it's tailored.
So our mission today is basically to distill this essential report for you. Whether you're a technology executive trying to map out your digital future, or maybe a compliance officer wrestling with all the new risks.
Or the CEO trying to figure out how to navigate the bank through all this. Survival, really.
Absolutely. We want to pull out the most crucial insights, give you a clear picture of why AI is so imperative now, what the competitive landscape looks like, and most importantly,
a strategic framework, something practical to turn these challenges into hopefully distinct advantages.
Exactly. So let's get right into it. We often chat about AI like it's just another tech upgrade, But this report really hammers home that for regional banks, it's much bigger than that.
Oh, definitely. It's fundamental. It's reshaping how banks operate, how they compete, how they even create value.
It used to feel like tech investments were maybe discretionary, something nice to have, gave you an edge perhaps.
Right, a potential advantage. But the report makes it starkly clear. AI now, it's a core imperative. It's not optional anymore.
Not optional for survival, even.
Precisely. For regional banks, this isn't just a nice to have. It really is about survival and looking ahead, future growth. They're in this tricky middle spot.
Squeezed almost.
Yeah, exactly. Squeezed between the giants, the big national banks pouring massive resources into AI.
And the fintechs.
And the nimble fintech challengers who are often built on AI from the ground up. They're AI native.
So for a regional bank, just sitting tight, that's not really a strategy anymore.
No, inaction is incredibly risky now. This is a real strategic juncture, a turning point.
So the report talks about this journey from automation to autonomy. That sounds like a really critical strategic shift that, every banking executive needs to get their head around.
It absolutely is. Understanding that progression, that journey is foundational if you want to chart your bank's future in this totally new landscape.
Okay, so how do we break down that journey? The report mentions 3 waves.
It does. And understanding these 3 waves of AI is key. Each one kind of builds on the last, and each demands, frankly, greater strategic foresight.
All right, let's start with the first wave then, the foundation.
Okay, so the first wave, the foundational layer, is narrow AI. You might also hear it called analytical AI.
We've kind of seen this around for a while in banking, right?
Oh yeah, for years. It's the silent workhorse, really. It's behind a lot of your fraud detection systems, your credit scoring models.
So specific jobs.
Exactly. It's designed for specific, predefined tasks. Its core strength is recognizing patterns in large sets of typically structured data. Think spreadsheets, databases.
So applications like flagging suspicious transactions in real time.
Perfect example. Or those AI-powered credit scoring models we mentioned. And a really big one, especially for back-office efficiency, is robotic process automation, RPA.
Right, automating those repetitive tasks. These all feel very targeted, very specific, delivering clear benefits we can measure.
That's the key. They're targeted, and the benefits are often measurable, usually in efficiency gains. With narrow AI, the human role is typically, an operator or maybe a user. You rely on the AI's output to make a decision or execute a task.
And the main payoff is internal.
Primarily, yes. It's about internal cost savings, efficiency, optimizing operations, doing the things you already do, but faster, maybe cheaper, maybe more accurately.
But it also builds something important for the next steps.
Crucially, yes. It builds that data discipline. Getting your data housed in order, understanding your processes, that's absolutely essential for leveraging the more advanced waves of AI effectively.
Okay, so narrow AI optimizes what banks already do. What about the second way? This is generative AI, right?
Yeah.
The one everyone's talking about.
That's the one, generative AI or GenAI. And this is where things start to get really disruptive. It doesn't just analyze existing data, it generates new, original content.
New stuff, like what?
Like human-like text, computer code, summaries of complex documents, even images or audio. It learns patterns from vast amounts of data, often unstructured data like text or images, and then creates something novel based on those patterns.
And the potential applications in banking here seem huge.
They really are exciting. We're talking about hyper-personalized customer communications, emails, chat responses that feel genuinely tailored.
Not just form letters.
Exactly. Or drafting marketing materials incredibly quickly. We're also seeing internal virtual experts, AI systems, that employees can query to get instant synthesized answers from internal knowledge bases.
Like having an instant expert on complex regulations or products.
Precisely. And it's even accelerating software development, helping developers write code, find bugs, translate old code.
That's a big deal for banks with legacy systems.
A very big deal. Now, the human role changes quite dramatically here, too.
How so?
With generative AI, you're less of an operator and more of a collaborator, or maybe a reviewer. You guide the AI, you prompt it effectively, and then you validate its output. Is it accurate? Is it appropriate? Is it helpful?
So you're working with the AI.
Exactly. And this is where we move beyond just cutting costs. GenAI starts creating significant value by enhancing both the customer experience and the employee experience. Interactions become more intelligent, more personalized, and scalable in a way they never could be before.
Okay, that's narrow and generative was the third wave. Agentic AI. That sounds different.
It is different. Agentic AI is the next frontier, and it really represents a true paradigm shift. If narrow AI analyzes and generative AI creates, Agentic AI does.
It does things autonomously.
Yes. These are AI systems designed to act as autonomous workers. They're goal-driven. They can perceive their environment, reason, plan, and then execute complex, multi-step tasks across different systems.
With minimal human help.
With minimal human intervention, exactly. Think of an AI agent given a goal like onboard this new customer, and it figures out the steps, verify identity, open accounts, set up services, and carries them out.
Wow. So what are some potential applications there? End-to-end client onboarding, like you said.
That's a prime example. Or imagine autonomous compliance monitoring an AI agent, constantly scanning transactions, regulations, internal policies, identifying risks, and even drafting initial suspicious activity reports for human review.
Proactive financial management, too, maybe.
Absolutely. An agent that doesn't just give advice, but actively manages aspects of a customer's finances based on their goals and real-time data.
So the human role shifts again. If the AI is doing.
The human role evolves to become more of an overseer, an exception handler stepping in when the AI encounters something novel or particularly complex. And importantly, a coach helping to train and improve the AI agents over time.
This sounds like it fundamentally changes how a bank operates.
It absolutely does. You're moving from augmenting your human workforce to actually deploying a digital workforce that acts autonomously.
And the strategic implications there, they must be profound, especially for technology executives and CEOs thinking about the long game.
Profound is the right word. It represents a fundamental shift in the potential value proposition. You move beyond just internal cost savings and efficiency.
Which is where narrow AI mostly plays.
Right. And you move towards external value-creating autonomy, redefining customer relationships, offering entirely new services.
So a regional bank strategy that only focuses on using AI for back-office savings. That's missing the bigger picture.
Completely. It's playing defense. It's short-sighted. The real transformative opportunity lies in leveraging these more advanced AI capabilities to fundamentally change how you engage with customers and the market.
And the financial incentives for getting this right, are they significant?
Staggering, frankly. The economic stakes are immense. Some analyses, and these are broad, suggest AI could add as much as $1 trillion in incremental value for banks globally.
$1 trillion. Okay, that's a huge number. Maybe hard for a regional bank CEO to wrap their head around. What about more concrete figures?
Fair enough. More conservative estimates suggest AI could boost banking industry profits by about 9%, which translates to roughly $170 billion by 2028. And that's primarily through productivity gains, the kind narrow and generative AI deliver.
Okay, $170 billion is still massive, but maybe feels a bit more grounded. And the report specifically calls out generative AI's impact now.
It does. It projects that GenAI alone could generate over $140 billion in annual value for the banking sector by 2025. That's just next year.
And where are the biggest gains expected?
Primarily in retail banking, think customer service, personalization, and corporate banking, perhaps around things like underwriting or client management. About $54 billion and $56 billion, respectively.
So the takeaway here isn't just theoretical future money, it's happening now, and it's not just about saving money on operations.
Not at all. This underscores a critical point, especially for technology execs and CEOs. AI adoption is a powerful engine for revenue growth and market expansion. The report cites a survey where 75% of business leaders said AI helped them expand their market share.
Then the flip side, the risk of not acting.
Equally stark. You risk being overtaken by competitors who are leveraging this technology effectively. You risk being abandoned by customers who come to expect the efficiency, personalization, and intelligence that AI enables.
So for regional banks, AI adoption isn't just a good idea.
It's essential. Essential for continued relevance, competitiveness, and frankly, survival.
Okay, the opportunity is clear, the imperative is clear. But the reality on the ground, it sounds like it's a bit more complicated. The report mentions this AI maturity chasm.
Yes, and it's a really important concept. Despite the hype and the potential, AI adoption reveals this deeply divided landscape. There's a significant gap opening up between the large, resource-rich financial institutions and their smaller regional counterparts.
How big is this gap? Is there data on that?
There is, and it's quite telling. While the financial services industry overall seems to be leading in GenAI implementation compared to other sectors, that's mostly the big guys.
Right?
The report cites figures like 79% of banks with over $250 billion in assets have either deployed or are actively deploying GenAI solutions. Almost 4 out of 5.
Okay, that's substantial. What about regional banks?
It plummets dramatically. For North American regional banks, a recent survey found that only 12% have deployed any GenAI use case at all. 12% versus 79%.
Wow, that is a huge disparity. What's causing that chasm?
It's a combination of factors, all of which hit regional banks harder. Prohibitive costs are a major one. These systems aren't cheap to build or run.
Makes sense.
Then you have the complexity around data privacy and security concerns, which are amplified when you have fewer resources dedicated to cybersecurity.
Regulatory hurdles too, I imagine.
Significant regulatory hurdles, yes. And just persistent deficits in specialized AI talent and the capital needed for these large-scale investments compared to the giants.
And this creates a kind of negative cycle.
Exactly. The report calls it a flywheel effect. The large banks have early successes, which justifies even more investment, which accelerates their capabilities further.
While the regional banks are struggling to even get off the starting blocks.
Precisely. They might get stuck in the experimental or pilot phase.
So what are the implications of this chasm for a regional bank CEO or CTO?
Well, first, it signals a growing competitive disadvantage that could become really serious, potentially insurmountable if not addressed.
A wake-up call.
Definitely. It highlights the urgent need for strategic prioritization. You can't do everything, so where do you focus your limited resources for maximum impact?
It may be rethink trying to build everything in-house.
It strongly suggests that. Collaborative approaches, partnerships, leveraging third-party platforms might be more viable than trying to match the in-house R&D of a JP Morgan Chase.
So it's about understanding where you are on that maturity curve and being really smart about how you move forward, leveraging unique strengths maybe.
Absolutely. Like that deep local knowledge and trusted customer relationships, those are assets AI can potentially amplify if deployed strategically. Bridging the gap isn't about becoming a mini version of a giant bank. It's about becoming a smarter, AI-powered regional bank.
Okay, so before regional banks can really harness generative AI or even dream about agentic AI, the report is clear. You've got to master the basics first. Pillar one, essentially.
Exactly. You need to get the foundation right, and that means mastering narrow AI. This is the workhorse. It delivers those measurable efficiency gains, improves security, and crucially builds the operational discipline needed for the more advanced stuff.
And a key area for this is the back office, right?
Yeah.
Still lots of manual work there.
Oh, absolutely. Many bank back offices are still burdened by high volumes of manual repetitive tasks. Think about compliance that alone can eat up over 20% of operational costs in some cases.
So RPA comes in here, robotic process automation.
Yes. RPA, often enhanced with some basic AI for things like document reading, is a fantastic starting point. These software bots mimic human actions, data entry, report generation, moving data between systems.
And for a regional bank, this feels like a lower risk way to start with AI.
Definitely. It's often lower risk. The impact is usually high and measurable quickly, delivering that immediate ROI, which can be crucial for getting buy-in for further AI investment.
Okay, give us some concrete examples of RPA making a difference.
Sure. Customer onboarding and KYC, know your customer.
Mm.
RPA can automate verifying identities, extracting data from documents, performing due diligence checks. It significantly cuts down the time and cost.
Loan processing.
Big one, loan and mortgage processing. Bots can automate gathering information from various sources, running initial credit checks, routing applications. The report mentions one commercial bank that automated mortgage appraisals.
And the result.
They got appraisals back 6.3 days faster on average, which helped cut the total mortgage cycle time by 2.6 days. That's a noticeable improvement for customers.
Definitely. What about finance tasks?
Accounts payable and reconciliation. Bots can capture data from invoices automatically, process payments, compare transactions between systems. The potential there is huge, maybe an 80% reduction in reconciliation time and a 90% drop in errors.
Those are impressive numbers.
Yeah.
And there was a specific case study, Federal Bank.
Yes, a really compelling one. They had this critical data merging task for compliance. Manually, it looked like it would take a year, needing maybe 200, 300 records processed per person per day.
Slow going.
Very. They brought in UiPath RPA. One bot could handle 250 records per hour, running 204/7. Yeah, they met their compliance deadline in half the projected time. That kind of result really speaks volumes to a technology executive looking for clear, impactful wins.
Okay, so efficiency is one major benefit of narrow AI. Security is another big one, right? Especially fraud detection.
Absolutely crucial. Financial fraud is a massive growing threat. And it's costly, not just the direct losses, but the report says U.S. financial institutions spend about $4.41 in associated costs for every dollar lost to fraud.
That's a huge multiplier.
Right.
And the old ways aren't cutting it.
The traditional rule-based systems, they struggle. They often generate a high number of false positives flagging legitimate transactions as fraudulent.
Which annoys customers.
Exactly. It creates friction, frustration, and can even lead to lost business if a customer's card gets blocked unnecessarily.
So how does AI help here? What's the advantage?
The AI advantage is its ability to learn and adapt. Machine learning models can analyze millions of transactions in real time, looking for incredibly subtle, complex patterns that indicate fraud. Patterns that a human analyst or a simple rule would likely miss.
It's like having a superpowered detective constantly watching everything.
That's a good way to put it, and it gets smarter over time as it sees more data.
Is there a case study for this too?
Yes, a U.S. regional bank facing a scary 30% year-over-year increase in fraud. They were really feeling the pain. They implemented an AI-driven system.
And the outcome?
Pretty transformative. They achieved a 97% accuracy rate in detecting fraud. They saw a 60% reduction in fraud losses within just 6 months.
60% reduction.
Huge. And they also cut the operational costs associated with fraud management by 25%. This system handles over 250,000 transactions daily, making decisions in under 2 seconds.
For compliance officers and CTOs, that's a powerful argument for investing in this kind of tech.
Absolutely. It delivers on security, efficiency, and ultimately protecting the bank's bottom line and reputation.
Now, implementing something like this, it's not just plug and play, is it? What do regional banks need to consider?
No, definitely not plug and play. Key considerations include, first and foremost, data quality and availability. The AI is only as good as the data it learns from.
Garbage in, garbage out.
Precisely. Integration with existing core banking and payment systems is crucial for that real-time analysis. Then there's the balancing act between security and customer experience, tuning the model to catch fraud effectively without generating too many false positives.
And the models need updating.
Constantly. Fraudsters are always evolving their tactics, so the AI models need continuous monitoring and retraining to stay effective. And finally, regulatory compliance. Especially for a compliance officer, you need to be able to explain why the AI made a certain decision, particularly if it leads to blocking a transaction or impacting a customer. Explainability is key.
Okay, fraud is critical. What about other decisions narrow AI can improve? Credit scoring comes up a lot.
Yes, AI-powered credit scoring is another major application with huge potential benefits, especially for regional banks focused on community lending.
What's wrong with the traditional way? FICO scores and the like.
Traditional credit scoring has limitations. It relies heavily on a pretty narrow set of historical credit data, loan payments, credit card history. This often excludes millions of people. The report mentions around 45 million credit-invisible Americans who don't have enough traditional credit history to get a score.
So they get shut out, even if they might be perfectly good borrowers.
Exactly. It perpetuates financial exclusion. Traditional models can also inherit historical biases present in the data, and they might miss good borrowers simply because their financial life doesn't fit the standard mold.
So how does AI change the game here?
AI-powered credit scoring can look at a much broader range of data points, often called alternative data.
Like what?
Things like utility payment history, rent payments, real-time cash flow analysis from bank accounts, even responsible e-commerce transaction behavior. Machine learning models can analyze these diverse data points to build a more holistic, nuanced, and potentially more predictive picture of someone's actual
He's
creditworthiness.
more inclusive.
Potentially much more inclusive, yes. And the business benefits for regional banks are really compelling. You get access to previously untapped customer segments, those credit invisibles.
Reduce default rates too, presumably, if the assessment is better.
That's the goal. Better risk assessment should lead to lower default rates. You also get faster loan processing times because the analysis is automated. You can offer more competitive loan products. And ultimately, it improves the customer experience, especially for those who might have been unfairly excluded before.
Are there examples of this working in practice?
Absolutely. The report highlights a fascinating case from Bank BRI in Indonesia. They serve a lot of rural borrowers, farmers, people without formal credit histories. Traditional scoring didn't work.
So what they do?
They developed an AI model that incorporated alternative data relevant to their customers, things like local crop yield patterns, commodity market prices, weather data.
Wow, really specific data.
Exactly. And it worked. It allowed them to extend microloans to millions of previously unbanked individuals, significantly reduce their default rates, and cut the loan processing time from about 2 weeks down to under 2 days.
That's incredible impact. Any other examples?
There's one about a commercial bank working with finbots.ai. They swapped out a simple traditional scorecard for an AI model. The results: a 14% reduction in loss rates, a 4% increase in loan approval rates, meaning they were safely lending to more people, and a massive 92% decrease in the time it took to develop the scorecard itself.
92% faster development.
Yeah,
That's huge fragility.
it really is. It shows how AI can improve not just the outcome, but the process itself.
So wrapping up this section on narrow AI,
Yeah.
it seems like these foundational projects, RPA, fraud detection, credit scoring,
Yeah.
they do more than just solve individual problems.
They absolutely do. For regional bank leaders, the value goes way beyond the immediate ROI, though that's important. Implementing these systems forces the bank to get its house in order.
Yeah.
You have to meticulously map your processes. You're forced to confront and break down those internal data silos. You have to instill data discipline and improve data quality. This builds crucial institutional muscle.
And it builds confidence.
Yes, delivering tangible results with narrow AI builds confidence and creates a culture that's more receptive to the deeper, more transformative changes that come with generative and agentic AI. In a way, narrow AI acts as a kind of Trojan horse for broader digital transformation. It gets AI in the door, proves its value, and paves the way for what comes next.
Okay, foundation laid with narrow AI. Now let's shift gears to the current big wave, the real disruptor, generative AI. This is the tech that creates, synthesizes, communicates.
Yeah.
It seems poised to completely redefine competitive advantage.
It really is. GenAI's impact is particularly profound in how it transforms interactions both externally with your customers and internally with your employees. It's not just automation, it's adding this layer of intelligence and personalization that was just impossible to achieve at scale before.
So let's talk customer engagement first. How does GenAI change that? Hyper-personalization is a term we hear a lot.
That's a key application. Because GenAI understands context and can generate really nuanced human-like language, it moves banks way beyond those generic scripted interactions.
Like better chatbots.
Much better chatbots, yes. Ones that can handle more complex queries, understand conversational history, and respond more empathetically. But it's also about providing contextual financial advice based on a customer-specific situation pulled from their data.
Yeah, and marketing.
Huge potential there. Generating hyper-personalized marketing materials, emails, offers, recommendations tailored to an individual's transaction history, financial goals, even recent life events inferred from data.
The report mentioned a bank already doing this, using a GPT-based engine.
Yes, one leading bank is using it for tailored marketing messages and seeing significantly improved campaign effectiveness. Imagine the power of that for a regional bank trying to deepen those community relationships, being truly relevant to each customer.
That's the external view. What about internally? How does GenAI help employees, the virtual expert, idea.
Right. GenAI can act as an incredibly powerful co-pilot for employees, boosting productivity in a couple of key ways. First is content synthesis,
Meaning?
meaning it can ingest and summarize massive amounts of unstructured information. Think long regulatory documents, research reports, internal policies, almost instantaneously.
You mean reading and summarizing faster than a human?
Orders of magnitude faster. The report gives the example of Citigroup using GenAI to summarize a 1,089-page document on new capital rules. That's a task that would have taken a human team weeks, maybe longer.
1,000 pages summarized quickly. That's a game changer for compliance and risk teams.
Absolutely. Another bank mentioned cut the time to produce investment briefs by over 90%, from 9 hours down to just 30 minutes. Think about the productivity unlock there.
And the second way it helps employees.
Software development and modernization. This is huge for banks grappling with aging tech stacks. GenAI code assistant tools can help developers write new code faster, find bugs more efficiently, document code automatically, and even translate legacy code like COBOL into modern languages.
Translating COBOL. That alone could be worth millions for some banks.
Potentially, yes. Goldman Sachs is mentioned using GenAI to automate the generation of software tests, freeing up developers for more complex tasks.
So these benefits better customer engagement, boosted employee productivity. They aren't just theoretical anymore. Early adopters are actually seeing this stuff happen.
That's right. This isn't science fiction. The report cites survey results from banking leaders who've already integrated GenAI. The feedback is overwhelmingly positive.
Like what specifically?
Huge majorities reported significant improvements. 90% saw better employee experience, 88% improved risk management, 85% boosted operational efficiency, and 82% enhanced customer satisfaction. Those are compelling numbers.
And that's driving adoption, presumably.
Rapid adoption, yes. An estimated 60% of banks have apparently deployed at least one GenAI use case already. That's reportedly the highest rate of any industry surveyed.
60%. That sounds high. But wait, does that square with the AI maturity chasm we just talked about, where only 12% of regional banks have deployed GenAI?
That's the critical nuance. That 60% figure is likely skewed heavily by the large national and global banks. It masks the reality that most regional banks, according to the report and other surveys, are still very much in the early experimental phases.
So they might have a pilot project, but it's not really integrated or scaled.
Exactly. They're struggling to move those promising pilots into full production where they deliver consistent value. And this brings us squarely to the challenges.
The gauntlet of challenges, as the report calls it, specifically for regional banks trying to harness GenAI.
Right. Because adopting GenAI is much harder when you have constraints on scale, resources, and deep technical expertise.
Okay, let's walk through those challenges. Data privacy and security must be near the top.
Absolutely. GenAI models are incredibly data hungry. They need vast amounts of data to train effectively, and in banking, that data is highly sensitive customer information.
Which brings in all the regulations, GDPR, CCPA.
Precisely. Navigating that complex regulatory web is tough, and the fear of data breaches is paramount. We've seen incidents where public chatbots inadvertently exposed user data, even credit card details.
A nightmare scenario for any bank, but especially a regional one relying on trust.
Exactly. Their cybersecurity infrastructure might be less sophisticated than the giants, making them potentially more vulnerable. This is a huge concern for compliance officers and CEOs alike.
Then there's cost. These things aren't cheap, right?
Not at all. High implementation costs and complexity are a major barrier. Training large language models or even running inference on pre-trained ones requires immense computational power. That translates to significant expense, both upfront and ongoing.
Tough for a regional bank with a limited IT budget.
Very tough. The report even quotes a Gartner prediction. By 2025, for a staggering 90% of enterprises, the cost of deploying GenAI might actually exceed the value generated initially.
Wow. That really underlines the need for careful ROI calculations and strategic prioritization. You can't just jump in blindly.
Definitely not. Then you have the regulatory and compliance hurdles. This is a massive one for compliance officers.
It's that box problem.
That's a big part of it. Many complex AI models, especially deep learning models used in GenAI, produce outputs without a clearly traceable, step-by-step decision process. They're like a black box.
And regulators don't like black boxes.
Not when those outputs affect high-risk decisions like credit scoring, loan approvals, or fraud detection. Regulators are increasingly demanding transparency, explainability, and auditability.
The EU AI Act is moving in that direction.
Very much so. It classifies many financial AI systems as high risk, which will come with stringent requirements. Regional banks often have fewer dedicated compliance resources to navigate this rapidly evolving landscape compared to the big players.
Okay, what else? Model reliability. Hallucinations?
Yes, model reliability and hallucinations. It's a well-documented quirk of current GenAI models. They can sometimes hallucinate, meaning they generate outputs that sound plausible but are factually incorrect or nonsensical.
Which is obviously unacceptable in banking. You can't have an AI giving out wrong financial advice.
Absolutely not. The risk is far too high. This means you absolutely need robust, human-in-the-loop processes for validation, especially for customer-facing or critical applications. Humans have to check the AI's work.
Which kind of dampens the pure productivity gains, right?
It does. It tempers expectations about fully automated processes. You still need that human oversight, which adds cost and time.
And the final hurdle, maybe the most practical one, integration.
Integration with legacy systems. For many regional banks, this is arguably one of the biggest practical barriers. Trying to connect these sophisticated, data-hungry, often cloud-based GenAI applications with your existing core banking systems.
Which might be decades old, monolithic, siloed.
Exactly. It's a monumental technical challenge. It requires significant integration effort, specialized skills, and can easily stall projects indefinitely. This problem is often particularly severe for regional banks carrying significant technical debt from older systems.
Okay, so the challenges are significant. Build versus buy.
Hmm.
How does a regional bank approach GenAI given these hurdles? Building their own giant model seems impossible.
Completely infeasible for almost all regional banks. But just buying a generic, off-the-shelf solution might not be good enough. Either it might lack the specific banking nuance or security required.
So is there a middle ground?
Yes, and the report highlights this as the most effective emerging path. The hybrid model of collaborate and customize.
Collaborate and customize. What does that mean exactly?
It means you license a powerful, pre-trained commercial large language model, LLM, from one of the major tech providers. Think Google, Microsoft, OpenAI, Anthropic. You leverage their massive investment in building the foundational model.
Okay, so you're buying the engine.
Right. But then the crucial step is you customize it. You fine-tune that licensed model using your bank's own proprietary data. This last-mile training makes the AI much more relevant and accurate for your specific context, products, and customers.
And there's a technique for this. RA.
Yes, retrieval augmented generation, RAG, is a key technique here. It essentially allows the AI model to access and retrieve relevant information from your bank's internal knowledge bases, product descriptions, policy documents, recent customer interactions in real time when generating a response.
So it grounds the AI's answers in the bank's actual reality.
Precisely. It significantly improves accuracy and relevance, making the AI much more useful. And importantly, it helps keep your sensitive proprietary data more secure because you're not sending it all off to train the public model, you're using it to augment the model's responses within your own controlled environment.
This sounds like it could actually level the playing field a bit.
It really could. The competitive advantage shifts. It's less about who can build the absolute biggest foundational model and more about the quality, uniqueness, and richness of your internal data and your deep understanding of your local market, which you use to fine-tune the AI.
That's a strength. Regional banks already have local knowledge.
Exactly. So the benefits of this hybrid approach are pretty clear. It's more cost-effective than building from scratch. It reduces time to market. You get better performance because you combine general capabilities with specific knowledge. Security can be managed more effectively, and you get competitive differentiation based on your unique data.
That's a really critical takeaway for any CEO or technology executive trying to figure out a practical path forward with GenAI, collaborate and customize.
It seems to be the most pragmatic and effective strategy emerging right now for institutions that aren't operating at the scale of the global giants.
Okay, we've covered narrow AI, the foundation, and generative AI, the current disruptor. Let's look over the horizon now to the third wave. Agentic AI. You said this is a true paradigm shift.
It really is. If we think about the progression, narrow AI analyzes, generative AI creates, agentic AI does. It acts autonomously. This moves AI from being a tool that assists humans to potentially becoming an autonomous worker itself.
An autonomous worker, that sounds like a big leap.
It's a huge leap. We're talking about AI systems that are given specific goals and can then independently perceive their environment, reason about the best course of action, make plans, and execute complex, multi-step tasks across various systems to achieve those goals.
All with minimal human supervision.
That's the key: minimal human intervention during the task execution. Humans might set the goals, monitor performance, and handle exceptions, but the agent carries out the work.
How is this actually made possible? What's the concept behind it?
The report talks about the idea of a digital factory. Imagine a workforce composed of interconnected AI agents, each specialized for different tasks. One agent might be expert at verifying documents, another at analyzing financial data, another at communicating with customers.
And they collaborate.
Exactly. They can collaborate, passing tasks between them to execute complex end-to-end workflows, much like a human team would, but potentially much faster and more consistently.
So if the AI is the worker, what happens to the human workforce?
Their role becomes significantly elevated, less doing the routine tasks, more strategic oversight, managing exceptions when the agents run into trouble, and importantly, coaching the AI agents, providing feedback to help them learn and improve over time.
This really does sound like a fundamental shift in the operating model for a bank.
It is. It requires rethinking organizational structure, job roles, skill sets, everything.
So let's paint a picture. What could this future vision of autonomous banking operations actually look like? Where might we see agentic AI applied?
The potential is vast, touching almost every facet of banking. Think about compliance and risk management.
How could agents help there?
The entire life cycle of anti-financial crime activities, KYC, AML, could potentially be handled by collaborating agents, analyzing documents, monitoring transactions in real time, assessing risk levels, even drafting initial suspicious activity reports, SARS for human review.
And the benefit for compliance officers.
Huge. Besides efficiency, such a system could create a complete, immutable audit trail of every step taken, providing unprecedented transparency for regulators. The report mentions HSBC is already exploring agentic principles for credit risk management.
Okay, compliance is one area. What about the customer side? You mentioned proactive management earlier.
Yes, proactive customer financial management. This is where agentic AI could truly revolutionize customer relationships. It could usher in what some call the do-it-for-me economy in finance.
Do it for me.
Yeah. Imagine an AI agent assigned to each customer, acting like a superpowered financial GPS or maybe even a personal CFO. It wouldn't just react to requests, it would proactively monitor the customer's entire financial picture: accounts, investments, goals, spending patterns.
And then what?
It could identify subtle cues indicating major life events, maybe a job change, a house purchase, retirement planning needs. And then, before the customer even asks, it could orchestrate the necessary financial support.
Like automatically suggesting refinancing options or adjusting savings plans.
Exactly. Optimizing savings, proactively negotiating better terms on debt, dynamically assembling personalized solutions from different products and services, all potentially without direct user commands for each action.
That's a level of personalization and proactivity that's hard to even imagine today.
It really is. And behind the scenes, in the back office, intelligent and resilient back office operations.
How so?
Think about data pipeline agents. Agents that monitor, orchestrate, and troubleshoot those complex extract, transform, load, ETL processes that move data around the bank.
So if a data transfer fails,
the agent could automatically retry it, investigate the cause, alert the right human staff if needed, maybe even perform simple self-heal functions for common errors, and rerun the job. This significantly improves operational resilience and reduces the need for manual intervention for routine issues.
these are profound visions. It leads directly to the strategic implications. Agentic AI isn't just about new tools. It forces a fundamental rethink of the entire business of banking.
Absolutely. The impact is far-reaching. One of the most significant areas is human capital.
The workforce.
The workforce. The shift from AI assisting work to AI potentially doing the work will profoundly impact banking roles. Many current tasks, especially routine ones, will likely be automated.
Which naturally raises fears about job losses.
Understandably. But it will also create new roles. Roles focused on AI governance, designing and training these agentic systems, ethical oversight, managing the human-AI collaboration, and focusing on the complex strategic problem-solving that AI can't yet do.
But this requires a massive shift in skills.
A massive industry-wide investment in reskilling and upskilling will be absolutely necessary. Preparing employees to work alongside, manage, and supervise a digital workforce is a huge challenge, and one that CEOs must lead from the front.
And if the work changes, the business models probably change too.
Almost certainly. The emergence of new business models is another key implication. As the bank's role evolves from being a reactive provider of products to a proactive, AI-powered financial partner.
The way it makes money might shift.
Exactly. Traditional reliance on net interest margin and transaction fees might diminish. New revenue streams could emerge from sophisticated advisory services powered by AI, platform fees for accessing certain AI capabilities, data analytics services, or maybe even outcome-based pricing for financial results achieved by AI agents.
We could see things like subscription-based banking becoming more common, or banking as a platform extending to AI services.
Those are definite possibilities. Maybe even marketplaces where customers or other businesses can access specialized financial AI agents. The possibilities are wide open.
Given all this potential disruption, what's the timeline? Is this far off?
That's the crucial point. The urgent need for preparation. The pace of AI development, particularly in the agentic space, is accelerating rapidly. Some very senior figures at major financial institutions, Bank of America, Citigroup, are mentioned, have publicly stated they believe agentic AI could have an economic impact even greater than the internet.
Greater than the internet. That's a bold claim.
It is, but it reflects the perceived scale of transformation. Whether it's 5 years away or 15, the strategic planning needs to start now. The window for preparation is closing much faster than many realize. Institutions that hesitate risk being fundamentally unprepared for this next wave.
And the report highlights a particular challenge here for regional banks,
Hmm.
right, related to their core value proposition.
Yes, a unique and potentially existential challenge. Regional banks have historically thrived by emphasizing personalized, high-touch service built on human trust and deep community ties. That's their differentiator against the scale of the giants.
But agentic AI seems to target that exact strength.
It does. If an advanced AI agent can offer superior, hyper-personalized, proactive financial management to 47, potentially at a lower cost, does the friendly local banker become obsolete? The customer's primary relationship might shift to the most effective agent, regardless of which institution technically provides it.
That's a sobering thought for regional bank leadership.
It is. It means regional banks simply cannot afford to ignore agentic AI, hoping their human touch will be enough. Their long-term survival might depend on integrating these autonomous capabilities strategically.
Not to replace humans, but to augment them.
Exactly. The winning strategy isn't AI or humans. It's likely a human plus agent model. Use the AI agents for their analytical power, their speed, their ability to handle complexity and routine tasks at scale, but leverage the human bankers for wisdom, empathy, ethical judgment, strategic thinking, and building that deep, trust-based relationship things AI can't replicate.
Blending the best of both worlds. That sounds like the key strategic imperative looking ahead.
It seems to be the most viable path for regional banks to not just survive, but potentially thrive in the age of agentic AI.
Okay, the AI race is definitely on. And as we've discussed, regional banks are in a unique, maybe tough position in this competitive arena. They're fighting a two-front battle, aren't they?
That's a good way to put it. On one side, you have the giants, the large national and global banks. They have scale, deep pockets, vast resources.
And on the other side?
The fintech challengers,
Mm-hmm.
nimble, often AI native, unburdened by legacy systems and bureaucracy, they compete on speed and user experience.
So for a regional bank to survive, let alone thrive, they can't just play the same game as either of those competitors. They need, as the report suggests, an asymmetric strategy.
Absolutely. Let's break down that competition. First, versus the large national banks. The biggest challenge here is the sheer scale disadvantage.
In terms of money.
Primarily, yes, capital and investment. The big banks have vast financial resources to pour into AI research, development, acquiring talent, building infrastructure. The report notes JP Morgan Chase acquired over 30 fintechs since 2021 alone.
30. That's huge. Regional banks can't possibly match that kind of spending.
No way. It creates a massive head start in capabilities. The second scale disadvantage is data volume and variety.
More customers, more data.
Exactly. The effectiveness of AI models, especially the more advanced ones, depends heavily on the amount and diversity of data they're trained on. Large banks simply have access to immensely larger and more varied data sets from their huge customer bases. This is a natural advantage for building powerful AI.
So given they can't match the scale, regional banks need to play differently. What does that asymmetric strategy look like?
The report outlines a few key elements. First, hyperlocal focus. Double down on the inherent advantage regional banks do have,
Right.
a deep, nuanced understanding of their specific local communities and customer bases.
Turn that knowledge into data.
Precisely. Translate that local insight into proprietary data that can be used to fine-tune AI models. An AI model fine-tuned on deep local knowledge might actually outperform a generic national model within that specific geographic or economic context.
Okay, hyperlocal focus. What else?
Strategic partnerships. Actively seek partnerships with fintech firms, specialized AI vendors, and technology platform providers. This gives access to cutting-edge AI solutions without bearing the crippling cost of building everything from scratch.
And the third element, customization.
Yes, last-mile customization. Become experts at taking those powerful commercial AI models, like the ones we discussed in the hybrid approach, and fine-tuning them with the bank's unique internal data and local insights. The competitive edge comes not from building the engine, but from making it run perfectly on your specific track for your specific customers.
More relevant, more effective AI tools than generic solutions.
That's the goal. It's about being smarter, not just bigger.
Okay, that's competing with the giants. What about the other front? The fintechs, the agility gap.
Right. The threat here is different. It's less about scale and more about speed and focus. The fintech threat is very real.
Because they're built differently.
Often, yes. Many are AI native. They were built from the ground up on modern cloud-based infrastructure without the baggage of decades-old legacy systems. This allows them to innovate, test, and deploy new AI-powered products and features much, much faster than a traditional bank typically can.
And their growth reflects that.
Projections suggest fintech revenues are growing nearly 3 times faster than traditional banking revenues. They're chipping away at traditional advantages like customer inertia or opaque pricing by offering superior digital experiences, often powered by AI.
But the relationship isn't purely adversarial anymore, is it? We're seeing more collaboration.
That's a really important shift, especially in the US. The dynamic is moving from competition to collaboration. We see banks increasingly investing in fintechs, partnering with them, even acquiring them, specifically to bring in new technology and AI capabilities quickly.
So this is actually an opportunity for regional banks.
A significant opportunity. Partnering with the right fintechs can be a fast track to acquiring advanced AI solutions, fraud detection, chatbots, data analytics that they couldn't realistically build themselves in a timely manner.
This ties into another trend, embedded finance.
Yes, the rise of embedded finance is reshaping the landscape too. Technologies like banking as a service and modern APIs allow financial products, loans, payments, accounts to be woven seamlessly into non-financial platforms and apps.
Like getting a loan directly through an accounting software or insurance at the point of sale online.
Exactly. This intensifies competitive pressure because financial services are popping up everywhere. But it also creates new opportunities for banks, including regional ones who are willing to provide the regulated banking infrastructure, the pipes that power these embedded experiences.
So opportunities to expand distribution, reach new segments, maybe new revenue streams from VAS partnerships.
Yes, but also challenges. You need robust, modern API infrastructure. You need to navigate the regulatory complexities of these partnerships. And there's a potential risk of brand dilution if you're just the invisible infrastructure provider.
It's a complex trade-off.
It is, which brings us back to the core strategy for regional banks in this whole competitive arena, finding the niche.
And that niche seems to be local.
Paradoxically, yes. As digitalization makes geography less important for basic transaction reach, it makes it more important for gathering that nuanced, specific local data.
The data that makes AI models better for that specific community.
Exactly. A regional bank's intimate knowledge of local economic conditions, community behaviors, specific industry clusters within their footprint, that's a valuable proprietary data set. It's hard for a national player or even a pure digital fintech to replicate that depth of local understanding.
So the winning strategy isn't to become generic, but to double down on being local and use AI to amplify that.
Precisely. Double down on your roots, using AI as an amplifier. The core value proposition doesn't necessarily change. It's still about high-touch, personalized service rooted in community trust. AI becomes the tool to deliver that value proposition more effectively, efficiently, and intelligently.
A high-tech, high-touch model.
That's the phrase often used. Let AI handle the routine, the mundane, the low-value tasks. Free up your human bankers to do what they do best. Build relationships, provide complex advice, exercise judgment, and be those trusted financial partners in the community.
That creates a defensible niche, something neither a purely digital player nor an impersonal giant can easily match.
A potentially very profitable and sustainable niche, yes, if you get that blend right.
So just to summarize the competitive landscape analysis from the report, regional banks have, say, moderate capital and data compared to giants, but high legacy system drag.
Right. Low agility compared to fintechs, they struggle with attracting top AI talent, but they often have very high local customer trust. And they face a high regulatory burden, more so than less regulated fintechs. Understanding that specific matrix of strengths and weaknesses is absolutely crucial for any regional bank crafting its AI strategy.
Navigating this whole AI revolution clearly needs more than just buying some tech. It demands a really clear, coherent strategy. And for regional banks operating with tighter resources, a disciplined, phased approach isn't just nice to have, it's essential.
Absolutely essential. You can't afford to waste resources on scattered initiatives that don't align or build on each other. The report outlines a really helpful four-pillar strategic framework specifically designed to guide regional bank leadership through this.
Okay, let's break down those pillars. Pillar number one.
Pillar one is build the foundation, data and infrastructure modernization. This cannot be overstated. Even the most sophisticated cutting-edge AI is basically useless without high-quality, accessible data to fuel it.
And this is often the biggest hurdle for regional banks.
Often the single greatest impediment, yes. Decades of adding technology layer by layer has often resulted in fragmented legacy systems, data trapped in silos, inconsistent data definitions. It's a mess in many places.
What are the common challenges technology executives face here?
Things like system fragmentation, a patchwork quilt of different systems that don't talk to each other easily, data quality issues, inconsistencies, duplicates, missing information, limited data governance, no clear ownership or standards, difficulty accessing data in real time, which many AI applications need, and navigating regulatory constraints around data usage and storage. It's a complex knot to untangle.
So pillar one is about tackling that head on. What are the key actions?
First, prioritize unified data governance. You need a centralized framework. Establish clear standards for data quality, define ownership, create protocols for access and usage, get everyone speaking the same data language. Create that single source of truth for key data domains. This is non-negotiable for data-hungry GenAI.
Second, modernizing the legacy systems. Sounds expensive.
It can be, which is why the report recommends phased legacy modernization. A full rip and replace of the core banking system is often too costly and risky for a regional bank. A more pragmatic approach uses things like middleware layers, modern APIs, or adopting a modular microservices architecture.
So you gradually decouple critical data and services from the old monolith, making them accessible for new AI tools without having to replace everything at once.
Exactly. It's a more manageable step-by-step approach. And third, the long-term goal is to adopt a data-centric architecture, shifting from thinking about systems first to thinking about data flow first. Maybe moving towards an event-driven architecture where real-time data flows into a centralized data lake or platform, breaking down those silos for good.
For a resource-constrained bank, how do they actually implement this? Where do they start?
Start with a data inventory. Understand what data you have, where it lives, and its quality. Leverage cloud-based solutions. They offer scalability and often lower upfront costs for data storage and processing. Focus on high-value data domains. First, prioritize the data needed for your most critical initial AI use cases. Implement automated data quality monitoring tools. And critically, create a dedicated data team or assign clear data governance responsibilities. Getting this foundation right is step one.
Okay, that's pillar one, the crucial data foundation. Pillar two.
Pillar two is a phased approach, prioritizing use cases. We touched on this earlier. The key here is avoiding pilot purgatory, where promising AI experiments never make it into full production. You need a deliberate, phased rollout.
Based on what?
Based on a careful balance of risk, complexity, and potential ROI. Start with the low-hanging fruit, build momentum, learn lessons, and then tackle the more complex, transformative initiatives. This secures early wins and gets crucial buy-in across the organization. Technology executives need to show progress.
So what does this phased rollout look like?
The report suggests a logical progression. Phase 1, foundational, maybe the first 0 to 12 months. Focus on low-risk, high-impact, narrow AI. Think internal process automation using RPA for things like KYC checks, mortgage processing steps, basic fraud alerts, simple chatbots for internal FAQs, automating report generation. The focus here is on clear, measurable ROI cost savings, efficiency gains. Build that internal confidence.
Okay, get some wins on the board, then phase 2.
Phase 2, expansion. Perhaps 12, 24 months. Once you've got some narrow AI successes and better data discipline, you expand into proven generative AI applications. But start where the risk is manageable, often internally first. Things like that internal virtual expert chatbot to boost employee productivity, maybe AI-assisted tools for contact center agents, personalized marketing content generation, document summarization, maybe AI assistance for loan underwriting, augmenting the human underwriter.
Still focusing on augmenting humans and improving internal processes or carefully manage external ones.
Exactly. Then, phase 3, transformation, 24 plus months. Now you can start carefully piloting agentic AI concepts, but do it in controlled, low-risk environments initially. Again, the focus should be on augmenting humans, not replacing them wholesale at first.
Like what?
Maybe an agentic co-pilot for relationship managers that proactively surfaces insights or suggests next actions. Perhaps autonomous orchestration of certain multi-step back-office processes, piloting proactive customer financial management alerts, using agents for predictive maintenance on IT systems, or even automated compliance monitoring checks. Always with human oversight.
How do banks choose which use cases to prioritize within each phase? There's so many possibilities.
Good question. The report suggests looking at two sets of factors, business impact factors. What's the quantifiable ROI? How does it align with our overall strategy? How much will it improve the customer experience? Does it provide real competitive differentiation?
And the other set, feasibility.
Right.
Implementation feasibility factors. How ready is our data? How technically complex is it to build and integrate? How sensitive is it from a regulatory perspective? And is the organization, culturally and skills-wise, ready to adopt it? Weighing these factors helps you pick the right use cases at the right time. Crucial for CEOs deciding where to place those bets.
Okay, pillar 1 is data. Pillar 2 is phased adoption. What's pillar 3?
Pillar 3 is absolutely critical, especially in banking. Establish robust governance. Managing risk. The Silicon Valley mantra of move fast and break things simply does not apply here.
Not an option in a regulated industry dealing with people's money.
Definitely not. Robust governance covering risk management, ethics, compliance, security cannot be an afterthought. It has to be designed into your AI strategy from day one. This is especially true for regional banks, where a single significant AI failure could be devastating reputationally and financially. This is paramount for compliance officers.
The AI risk landscape is pretty complex, isn't it? What are the key areas? It is complex. You've got regulatory risk intense scrutiny from the OCC, FDIC, Federal Reserve, CFPB, especially around fairness, transparency, and consumer protection when AI impacts things like credit decisions.
Ethical risks, too.
Ethical risk, particularly the risk of AI perpetuating or even amplifying societal biases, leading to discriminatory outcomes. This has huge social and legal implications. Then there's security risk. AI introduces new attack vectors, like adversaries trying to poison the training data or trick the models, model inversion attacks, prompt injection.
A big one for regional banks.
Reputation.
Reputational risk.
Yes.
Damaged trust from AI failures, biased decisions, security breaches, inaccurate advice can severely harm that core community trust advantage.
So how do you build robust governance? What are the key actions? First, create a centralized AI governance body. This could be a dedicated committee or clear ownership assigned to a senior individual, maybe the CIO, the Chief Risk Officer, CRO, or perhaps even a new role like a Chief AI Officer. This body needs clear authority to set strategy, define risk appetite, establish ethical guidelines, and oversee implementation. They define the policies, the roles, the processes, the reporting structure.
Okay, central ownership. What next? Managing the specific risks.
Yes. Proactively manage ethical and regulatory risks. This means tackling algorithmic bias head-on, using fairness-aware algorithms where possible, conducting regular bias audits, ensuring diverse training data, monitoring outcomes across different demographic groups. It means strict adherence to data privacy regulations like GDPR and CCPA, using techniques like data anonymization and encryption.
And the black box problem.
Addressing transparency and explainability. Overcoming that black box challenge is crucial. This involves using explainable AI frameworks and tools where feasible, and maintaining meticulous documentation throughout the AI lifecycle so decisions can be interpreted and audited.
And finally, security needs an upgrade too.
Absolutely. Fortify cybersecurity defenses. AI introduces new threats, sophisticated deepfakes used for fraud, AI-powered automated phishing attacks, data poisoning attempts. Banks need to counter these with their own AI-powered defense tools, strengthening things like multi-factor and biometric authentication, and continuous security training for staff. Specific to GenAI, defending against prompt injection attacks requires careful input validation and output monitoring.
So pulling it all together, an effective AI risk management framework needs.
It needs systematic risk assessment tailored to AI, comprehensive model documentation, rigorous testing including adversarial testing, ongoing performance monitoring, clear incident response plans for when things go wrong, and regular independent audits. Compliance officers need this structure to ensure accountability.
Makes sense. Data, phased adoption, governance. What's the fourth pillar?
The fourth, and arguably the most challenging pillar, is invest in people, culture, and talent. Ultimately, technology is only as good as the people who build, manage, and use it. You can have the most advanced AI model in the world, but if your organizational culture resists change or your workforce lacks the skills to leverage it, your AI strategy will fail.
This often gets overlooked, doesn't it? The human element.
It does, but it's absolutely critical, especially for regional banks where culture can be deeply ingrained and accessing specialized talent is tough.
Well, let's talk about that AI talent challenge. Competition is fierce. How can regional banks compete?
It's incredibly difficult. They often can't match the salaries offered by big tech firms or the giant banks for top-tier AI PhDs. So while some targeted hiring for leadership is needed, the primary focus for most regional banks has to be on upskilling and reskilling their existing workforce.
Training their own people.
Yes. Investing in comprehensive training programs to build AI literacy at all levels. Everyone needs a basic understanding. Then, more specialized training for those in relevant roles, data analysts, developers, risk managers, even customer-facing staff who will use AI tools.
So maybe a small core team of AI experts, supplemented by partnerships, but the main effort is internal upskilling.
That seems like the most pragmatic approach for many regional banks. Leverage the business knowledge your current employees already have and give them the AI skills they need. Create clear career paths for employees who want to develop these skills.
Beyond skills, there's the culture piece, fostering a culture of innovation and learning. How do you do that in a traditionally conservative banking environment?
It has to start at the top. Leadership championship is non-negotiable. Leaders need to visibly support AI, communicate a clear, positive vision for how it will help the bank and its employees, not just replace jobs.
Creating psychological safety.
Exactly. An environment where it's okay to experiment, to try new things, even to fail sometimes as part of the learning process. Without that safety, people won't take the necessary risks to innovate.
What are some concrete strategies for shifting the culture?
Visible executive sponsorship, as mentioned. Offering continuous learning programs, online courses, boot camps, workshops. Implementing structured change management that addresses not just the technical changes, but the human and emotional side of adopting AI. Using recognition and incentives to encourage adoption and skill development.
And addressing the fear factor, the job loss anxiety.
Crucial. Banks need to proactively redefine roles and responsibilities. Be transparent about how AI will change jobs, but frame it constructively. Emphasize AI as a collaborative partner.
The human plus AI model again.
Yes. AI handles the routine, data-intensive tasks, freeing up humans to focus on more strategic, creative, complex, and customer-focused work, the things humans do best. This narrative helps allay fears and shows employees a path forward where their skills remain valuable, just applied differently.
And this might even create entirely new roles within the bank.
Absolutely. The report mentions roles like AI ethics officer, AI trainers, people who use their domain expertise to refine AI models, human AI collaboration specialists who design effective workflows, and AI experience designers focused on making AI tools intuitive and user-friendly. Investing in people is investing in the success of the entire AI transformation.
Okay, we have the four pillars: foundation, phased adoption, governance, and people. But even with a great strategy, roadblocks will pop up. Let's talk about overcoming some common barriers.
Definitely. Obstacles are inevitable. The first big one we keep coming back to is legacy system integration.
What does this look like in practice? What are the symptoms?
It manifests as things like being unable to access the real-time data AI needs, facing prohibitively high costs for custom integration work, experiencing performance bottlenecks when new systems try to pull data from old ones, or running into security concerns when trying to connect modern cloud services to older on-premises systems. It's a constant headache for technology executives.
So what are the strategies to work around this, short of a full replacement?
There are a few pragmatic approaches. An API layer approach is common, building a modern layer of application programming interfaces on top of legacy systems to provide standardized access for new AI applications.
Kind of like a universal adapter.
In a way, yes. Another is data replication, setting up processes to regularly copy relevant data from legacy systems into modern data platforms, like a data lake or warehouse, that are optimized for AI analysis. It avoids hitting the legacy system directly for every query.
And the microservices idea again.
Yes, pursuing a microservices architecture over the long term, gradually breaking down parts of the legacy monolith into smaller, independent services that can be modernized or replaced individually. It's a journey, not an overnight fix.
Okay, integration is one hurdle. What about money, budget constraints, and ROI pressure?
A huge one for regional banks. They simply have fewer resources. This shows up as difficulty getting funding approved for longer-term AI initiatives that don't have immediate payoff. Intense pressure from finance or the board for quick, demonstrable returns on any AI spending. Insufficient budgets allocated for the necessary infrastructure upgrades, and finding it hard to compete on salary for scarce AI talent.
How do banks navigate this?
One strategy is taking a portfolio approach to AI investment. Don't put all your eggs in one basket. Maybe allocate, say, 70% of your AI budget to those quick win projects with clear near-term ROI, like RPA. Use that success to fund the next steps. Allocate maybe 20% to more strategic bets that build important future capabilities, even if the ROI is less immediate. And perhaps 10% to moonshots, exploring truly transformative, longer-term possibilities.
Balancing short-term needs with long-term vision. Are there other funding models?
Yes, the report mentions exploring alternative funding models. Things like revenue-sharing partnerships with tech vendors, where they share in the upside generated by the AI. Forming consortiums with other regional banks to share the cost of developing or licensing certain AI platforms. Pay for performance contracts, or even making venture investments in promising fintech partners. Getting creative about funding is key.
And the last major barrier, data quality and availability issues. Even if you can access the data, it might not be good enough.
Exactly. Common manifestations are inconsistent information across different systems, missing or incomplete data fields crucial for training AI models, lack of sufficient historical data for certain types of analysis, and lots of valuable information locked away in unstructured formats like PDFs, emails, or call notes that are hard for traditional AI to use.
So how do you deal with imperfect data? You can't wait until it's perfect.
No, you can't. One approach is a tiered data quality approach. Prioritize cleaning and improving the data that's most critical for your highest priority AI use cases first. Don't try to boil the ocean. Utilize automated data quality tools. There are platforms that can help detect inconsistencies, duplicates, and other common issues automatically.
Look outside the bank, too.
Consider data enrichment partnerships. Supplementing your internal data with relevant external data sources can sometimes fill gaps or improve model accuracy, especially for things like alternative credit data. And finally, for technology executives facing significant data limitations, maybe start with AI applications that are less sensitive to perfect data. Some internal process automation or basic analytics might still deliver value even if the data isn't pristine.
Okay, those are practical ways to tackle common barriers. Now, how do you know if any of this is actually working? Measuring success seems critical.
Absolutely essential. Effective measurement, defining and tracking the right key performance indicators, KPIs, is crucial for several reasons. It helps guide your AI initiatives, ensuring they stay on track. It's necessary to justify the ongoing investment to stakeholders, especially the board and finance department, and it demonstrates the actual value being delivered. CEOs and technology executives need these metrics.
The report breaks down KPIs into categories.
Yes, which is helpful. First, there's the obvious one, financial impact.
The bottom line.
Right. Metrics like operational cost reduction, staff hours saved through automation, increases in cross-sell or upsell rates, new account acquisition attributed to AI-driven marketing, reduction in fraud losses, improvements in loan portfolio quality, or avoidance of compliance penalties. Hard dollar figures.
Then, customer impact.
Customer experience metrics. Things like customer satisfaction scores, CSAT, Net Promoter Score NPS, reduction in customer service response times, measures of personalization effectiveness, increases in digital channel engagement, or reductions in customer complaint volume related to specific processes.
What about internal operations?
Operational excellence. Metrics like reduction in process cycle times, increases in straight-through processing rates, where transactions go through without manual intervention, measures of employee productivity gains, internal employee satisfaction with AI tools, and adoption rates of new AI-powered systems.
Are there AI-specific metrics too? Things the tech team would
Yeah.
track?
Yes, AI-specific technical metrics, these are vital for the technology executives and data science teams. Things like model performance accuracy, precision, recall, F1 scores. For GenAI, tracking hallucination rates, measures of fairness and ethics like demographic parity checks or bias detection scores, and technical performance metrics like model latency, speed, throughput, volume, and monitoring for model drift, where performance degrades over time.
And finally, strategic progress.
Strategic progress metrics. These look at the bigger picture. Things like tracking the bank's overall AI capability maturity level against a defined roadmap, measuring the number of use cases successfully implemented versus targets, tracking the development of AI talent within the organization, the health of the innovation pipeline, and even qualitative assessments of competitive positioning based on AI capabilities.
So how do you build an effective measurement framework using these?
The key advice is establish clear baselines before you implement AI so you know your starting point. Set specific, measurable, achievable, relevant, and time-bound, SMART targets for each key metric. Create a balanced scorecard that includes metrics across all these categories: financial, customer, operational, technical, strategic. Implement regular reporting and review cadences. And be prepared to evolve your metrics over time as your AI initiatives mature and your strategic priorities shift.
That makes sense. Measurement needs to be dynamic, just like the AI journey itself. All right, we've covered strategy, implementation, challenges. But we can't talk about AI in banking without diving deeper into the regulatory and ethical landscape. This is absolutely critical territory, especially for compliance officers and CEOs.
It really is. Implementing AI doesn't happen in a regulatory vacuum. Regional banks have to navigate this complex and, frankly, still evolving environment very carefully.
Is there a single clear rule book for AI in banking yet?
Not really. No single comprehensive framework specifically for AI exists right now. However, a whole host of existing regulations and guidance documents have very direct implications for how banks can use AI.
Like what? What existing rules apply?
Well, fundamental ones like fair lending and consumer protection laws, think the Equal Credit Opportunity Act, EVOA, the Fair Housing Act. Regulators like the CFPB have been very clear. These laws apply to AI-driven lending decisions just as they do to human ones. Using a black box algorithm is not an excuse for discriminatory outcomes.
So fairness is paramount. What else?
Risk management and governance. Existing guidance, like the Federal Reserve's SR Evan 7 on model risk management or OCC bulletins, already requires rigorous validation, testing, and ongoing monitoring of any model used in banking, and that absolutely includes AI models.
Data privacy too, obviously.
Data privacy and security regulations are huge. Things like the Gramm-Leach-Bliley Act, GLBA in the US, or GDPR in Europe, CCPA in California, they all impose strict requirements on how banks collect, use, protect, and get consent for customer data, which is the lifeblood of AI.
Has there been any guidance specifically about AI from the regulators yet?
Some initial steps, yes. The FDIC, Federal Reserve, and OCC have issued requests for information on banks' use of AI and provided some guidance, often related to managing risks associated with third-party AI vendors or ensuring proper oversight. It sets a preliminary framework while more detailed rules develop.
So the existing rules provide a baseline. What are the emerging trends? Where is regulation heading?
Several key expectations are taking shape. Definitely increased demand for explainability requirements. Regulators want banks to be able to explain how their AI systems arrive at decisions, especially high-stakes ones. We're seeing movement towards more detailed documentation standards for the entire AI lifecycle design, data, testing, monitoring.
Fairness testing getting tougher.
Fairness testing requirements are likely to become more formalized and rigorous, going beyond simple checks. There's also a growing emphasis on the need for meaningful human oversight, ensuring a human is involved in or can override critical decisions made by AI. And an expectation for regular reassessment of AI systems to detect performance degradation, model drift, or emerging biases over time.
Given this direction, what should compliance officers be advising their banks to do now? What are the proactive compliance strategies?
The report suggests several key strategies. First, documentation by design. Don't wait until the end to document. Build comprehensive documentation into every phase of the AI lifecycle, from initial design and data sourcing through testing, deployment, and monitoring. Create that audit trail as you go.
Focus on explainability from the start.
Absolutely. An explainability focus. Where possible, prioritize using AI models that are inherently more transparent. For more complex black box models, invest in and utilize explainable AI, XAI tools and techniques to provide insights into their decision making.
Testing needs to be thorough.
A robust testing regime is crucial. This has to go beyond just checking technical accuracy. It needs to include specific tests for bias, adversarial testing, seeing how the model reacts to unexpected or malicious inputs, and thorough scenario analysis.
And keep watching it after launch.
Continuous monitoring is non-negotiable. Track AI performance in production, not just for accuracy, but also for potential drift, degradation over time, or the emergence of unintended biases as the real-world data changes.
How can banks implement this practically?
2 key steps. Establish a proactive regulatory engagement strategy. Don't wait for the rules to hit you. Engage with regulators, participate in industry discussions and sandboxes, understand their concerns early, and build that strong internal governance framework. We talked about the cross-functional committee, clear AI risk assessment processes, robust audit trails. Embedding compliance into the AI strategy from the start isn't just about avoiding penalties. It's competitive advantage enabling confident deployment.
Beyond strict compliance, there's the whole ethical dimension. This seems particularly important for regional banks trying to maintain trust.
Fundamental. Addressing the ethical considerations of AI is not just a nice to do. It's absolutely core to preserving that human-centered approach and the trust advantage that regional banks often have over larger, more impersonal institutions or purely digital players. Getting ethics wrong can be incredibly damaging.
What are the biggest ethical minefields here? Bias comes up constantly.
Fairness and bias mitigation is definitely a major one. AI systems, particularly machine learning models, learn from data. If that data reflects historical societal biases, and it often does, the AI can inadvertently learn, perpetuate, and even amplify those biases in its decisions.
Especially in areas like lending.
Exactly. Training data might reflect past discriminatory lending practices. Or the AI might pick up on seemingly neutral proxy variables like ZIP code or certain spending patterns that are highly correlated with protected characteristics like race or ethnicity, leading to discriminatory outcomes even if the protected characteristic itself wasn't used.
The report had an anecdote about that, a regional bank's model.
Yes, a cautionary tale. A regional bank developed a credit scoring model that, while technically accurate based on the data, ended up disproportionately declining applications from certain minority neighborhoods. Even though race wasn't an input, other factors acted as proxies, creating an unintended disparate impact. They had to completely redesign their approach. It shows how careful you need to be.
Transparency and explainability are ethical issues too, not just regulatory ones.
Absolutely. Customers have an ethical right to understand, at least in principle, why a decision that significantly affects them, like a loan denial, was made. The black box is an ethical problem because it undermines autonomy and accountability. It's also crucial for building and maintaining trust. People are less likely to trust decisions they can't understand.
What about data privacy from an ethical standpoint? Beyond just compliance.
Data privacy and customer autonomy raise deeper questions. How much customer data is it ethically appropriate to collect and use, even if legally permissible? How can banks ensure truly informed consent beyond just getting users to click through unread terms of service? What are the ethical limits on personalization? When does helpfulness cross the line into being intrusive or manipulative? Balancing the benefits of AI with customer comfort and autonomy is a key ethical challenge.
And ensuring everyone benefits. Digital inclusion.
Digital inclusion and accessibility is another critical ethical consideration. As banking becomes more AI-driven in digital, there's a real risk of leaving certain populations behind.
Who's most at risk?
Elderly customers who may be less tech-savvy, individuals with disabilities who need accessible interfaces, the unbanked or underbanked who lack digital access or traditional data footprints, rural communities with poor internet connectivity, non-English speakers. Banks have an ethical responsibility to ensure their AI-powered services don't create new barriers.
So what are some inclusion strategies?
Offering multi-channel accessibility, ensuring there are always human alternatives available. Applying universal design principles to make digital interfaces usable by everyone. Leveraging AI itself for things like language translation features, providing community education programs on digital banking tools, and ensuring there are affordable, basic banking options that don't require the latest smartphone or sophisticated tech usage.
So how does a bank formalize its approach to ethics?
By building an ethical AI framework. This involves several steps. Establish clear ethical principles that guide AI development and deployment fairness, transparency, accountability, privacy, security, reliability, inclusion. Create governance structures, like an ethics committee or review board, to oversee adherence to these principles. Implement ethics by design, embedding ethical considerations into every stage of the AI lifecycle, not just checking at the end. And measure ethical performance, actively monitoring for bias and ensuring AI systems align with the bank's values.
So ethics needs to be as structured and deliberate as the technical development itself.
Absolutely. For regional banks, leading with ethics isn't just the right thing to do, it reinforces their brand identity and strengthens that crucial bond of trust with their communities.
Okay, let's look ahead now. The AI field is constantly evolving. What are some of the key trends shaping the future of AI in banking that regional bank leaders should have on their radar?
It's moving incredibly fast. One key trend is multimodal AI. Current AI often focuses on a single type of data text, or numbers, or images. Multimodal AI is about integrating and understanding multiple types of inputs simultaneously.
Like understanding text and images together, or speech and facial expressions.
Exactly. Imagine an AI that can process a mortgage application form, text, while also analyzing photos of the property, visual, and maybe even understanding the applicant's spoken explanations, natural speech, during a video call. It allows for much richer, more sophisticated interactions.
What are the strategic implications for regional banks?
Multimodal AI could lead to much more intuitive, accessible, and personalized customer experiences. It could help bridge the digital divide by allowing customers to interact in more natural ways, maybe making complex financial discussions feel less intimidating.
What's another big trend? Privacy concerns aren't going away.
Definitely not. Which leads to the rise of federated learning and privacy-preserving AI techniques. Federated learning allows AI models to be trained across multiple decentralized devices or servers, like customer phones or different bank branches, without the raw data ever leaving its original location. Only aggregated model updates are shared.
In other techniques.
Things like homomorphic encryption, which allows computations to be performed on data while it's still encrypted, or differential privacy, which adds statistical noise to data to prevent individual identification.
The strategic implication here seems huge for trust.
Massive. These techniques offer a potential path to leverage the power of distributed data for training better AI models while maintaining customer privacy and data security. For regional banks, mastering these approaches could become a significant competitive advantage, positioning them as leaders in responsible AI and reinforcing that trust factor.
What about technologies further out, quantum computing?
Quantum computing and AI is another area to watch, though it's still in earlier stages. Quantum computers, with their fundamentally different way of processing information, have the potential to dramatically accelerate certain types of AI calculations.
Like what kind of calculations?
Complex optimization problems, think portfolio optimization on a massive scale. Advanced risk modeling that can simulate vastly more scenarios. Or perhaps even breaking current encryption standards, which has huge security implications, but also enabling new forms of secure communication. For AI specifically, it could supercharge certain machine learning algorithms.
So what should a regional bank do about quantum now?
Realistically, most won't be investing directly in quantum research. The strategic implication is to monitor developments closely, be aware of the potential disruptions and opportunities, and be prepared to partner with specialized providers who start offering quantum-enhanced AI services down the line. Early adoption through partnerships could offer significant advantages in areas like risk or fraud.
And the final trend, ecosystems.
Yes, the future seems to be about AI ecosystems and collaborative intelligence. We're moving away from monolithic, do-everything AI systems towards more interconnected ecosystems. Think AI marketplaces where banks can access specialized AI services from various providers. Think banking-as-a-service models extending to offer AI capabilities. Think collaborative development initiatives.
This sounds potentially very beneficial for regional banks.
It really is. This ecosystem approach allows them to access sophisticated, specialized AI capabilities without needing massive internal R&D teams for everything. They can become expert orchestrators, strategically combining best-in-class AI services from partners with their own unique data and customer insights to create distinctive value propositions. It plays to their potential strengths in understanding customer needs and managing relationships.
It's helpful to see these abstract concepts grounded in reality. The report includes a case study of First Horizon Bank.
Yes, a great real-world example. First Horizon is a sizable regional bank, around $89 billion in assets, facing challenges very familiar to others in their peer group. Complex technology, legacy systems, fragmented data, intense competition, resource constraints.
So how do they approach their AI transformation? Does it align with the four pillars we discussed?
It aligns remarkably well. They started with Pillar 1, foundation building. They established a dedicated data and analytics team, prioritized data governance, and invested in building a modern, centralized data platform to get their data house in order.
Critical first step. Then,
They moved into Pillar 2, phased adoption, focusing first on narrow AI successes. They implemented advanced AI-powered fraud monitoring, which resulted in a 35% reduction in fraud losses and a 22% decrease in false positives, hitting both security and customer experience. They also deployed RPA bots in areas like loan processing, achieving a 40% reduction in processing time.
tangible wins, building momentum. Did they move into GenAI?
Yes, that was their next phase, generative AI expansion. They developed an internal virtual expert using GenAI to help employees find information faster, reporting a 60% reduction in information search time. They also used GenAI for personalized marketing campaigns, leading to a 28% increase in customer response rates.
And pillar 4, the people and culture.
They addressed Pillar 4, cultural transformation proactively. They invested in comprehensive training programs for employees at all levels. They focused on clear communication, emphasizing how AI would augment roles and improve work, not just eliminate jobs. They worked to build buy-in and manage the change effectively.
So what were the overall results for First Horizon?
The reported results are impressive. A 22% overall improvement in operational efficiency, 18% growth in revenue attributed partly to AI initiatives, a 35% reduction in key risk indicators, and significantly a 15-point increase in their Net Promoter Score, NPS, showing a major positive impact on customer satisfaction.
Those are the kinds of results that get a CEO's attention. What are the key lessons other regional banks can take from First Horizon's journey?
Several key takeaways emerge. First, the data foundation is absolutely critical. You have to invest there first. Second, start small but think big. Get those early wins with narrow AI, but have a longer-term vision for GenAI and beyond. Third, maintain a human-centered approach. Focus on how AI can empower employees and improve customer relationships. Fourth, leverage strategic partnerships. They didn't try to build everything themselves. And finally, commit to continuous learning and adaptation. This is an ongoing journey.
That's a fantastic practical example. Yeah. So as we bring this all together, what are the overarching strategic imperatives for regional banks to not just survive, but actually succeed and maybe even reclaim competitive advantage in this AI era?
The report synthesizes it down to 5 core imperatives.
Okay, number 1.
Be strategically selective. You can't do everything. Focus your limited resources on AI applications that directly enhance your unique competitive differentiators and address the specific needs of your target market. Don't chase every shiny new AI object.
Number 2.
Prioritize the human plus AI hybrid model. We keep coming back to this. Design AI to augment your human bankers. Handle the routine and enable them to provide deeper, more valuable, relationship-based service. That's the sweet spot for regional banks.
Third imperative.
Leverage collaborative approaches. Embrace partnerships. Work with fintechs, technology providers, maybe even other banks through consortiums to access advanced AI capabilities efficiently. Don't go it alone.
Fourth, data again.
Make data a strategic asset. Your unique local market knowledge and customer data is a potential goldmine for AI. Invest seriously in data quality, accessibility, and governance to create AI models that can outperform generic solutions in your specific context. Treat data like the critical asset it is.
And the final imperative.
Lead with values and trust. Proactively address the ethical considerations, privacy, security, fairness, transparency. Double down on being the trustworthy, responsible financial partner for your community. In the age of potentially opaque AI, trust becomes an even more valuable currency.
So selective focus, human augmentation, collaboration, data as an asset, and leading with trust. That feels like a solid strategic compass.
It provides a clear direction. The report emphasizes that AI transformation is absolutely a continuous journey, not a destination you arrive at. It requires a fundamental, ongoing rethinking of strategy, operations, culture, and customer relationships.
But the four-pillar framework, build the foundation, phased adoption, robust governance, invest in people, provides that structured roadmap for the journey.
Exactly. By systematically working through those pillars, regional banks can navigate the complexities, manage the risks, and hopefully unlock the significant value AI offers.
So as we wrap up this deep dive, the key message seems to be that the AI revolution isn't necessarily the death knell for regional banks. It's actually a profound opportunity, isn't it?
A profound opportunity to amplify their core historical strengths, those deep community relationships, that invaluable local market knowledge, and the ability to offer truly personalized, trust-based service. AI can supercharge those very things.
The outcome isn't set in stone just because of size or resources.
Absolutely not. The outcome is not predetermined by scale alone. With strategic clarity, disciplined execution of a plan like the one outlined, and an unwavering commitment to their core values, regional banks absolutely can harness AI. They can use it to write a vibrant, successful new chapter.
Which leads us to our final provocative thought for you, our listener. As AI increasingly takes on the doing in banking, automating tasks, executing processes, even making proactive decisions, what new, higher-value human roles will emerge at the very heart of community banking? And perhaps more fundamentally, how will regional banks truly define the essence of relationship in this new, autonomous, yet hopefully human-augmented future?
Really interesting questions to ponder.
Definitely something to consider as you chart your own AI journey.